Hello, my name is Clive Corcoran and welcome to my YouTube channel, the Corcoran Codex. What I want to discuss in this video is actually a rather remarkable development that has taken place in recent years, and it involves the massive expansion in the balance sheet of the US Central Bank, the Federal Reserve. At one point, the Fed's balance sheet reached $9 trillion. That was sometime during the first quarter of 2022. And when this is being recorded, the balance sheet has contracted to around $6.7 trillion, which many people still believe is much larger than is really justified. But let me just start by saying that what the Fed owns, what in fact it has on the asset side of its balance sheet, are those assets which it has acquired with various funds. What the Fed owes, in other words, the source of the funding, are its liabilities. I'll come on and say more about this in a moment. The Federal Reserve is empowered uniquely to create currency. This is quite a wonderful capability of the Federal Reserve. Now, most of the currency that is created only exists as a book entry on the Fed's ledger system. Over here we can see all this currency in printed form, but in fact most of the actual currency the Fed creates does not actually exist in printed form, but in virtual form or accounting form. Now, US currency only becomes a liability for the Fed when it has entered circulation. So one of the key things to explain about the operational side of the US Central Bank is how is it able to take this currency that it can essentially conjure up and ensure that it is part of the money supply which is in circulation. The asset side of the balance sheet of the Fed consists mainly of US Treasury securities, government securities, agency-backed MBS or mortgage-backed securities, and loans extended to member banks, the banks in the United States that are part of the reserve system, and these loans can be extended to member banks through the repo and discount window facilities. I'm not going to discuss the repo mechanisms in this particular video, but you will be able to, if you wish, find a long discussion about how the repo market works on my YouTube channel. Now, this is really a key insight into how the Fed actually operates. When the Fed buys government securities, say from the banks, or extends loans to them through the discount window, the way that it pays the banks, let's say, or makes the advance, is by crediting the reserve account which all banks in the United States are required to hold within the Federal Reserve System. So these reserves are effectively deposits that the banks are required to hold within the central bank or the reserve system. And what the Federal Reserve can then do, let's say it's going to buy a sizable number of 10-year Treasury notes from, I don't know, JP Morgan. What it will do is it will pay JP Morgan by simply crediting a book entry effectively on the balance that JP Morgan has within the reserve system. So there's no actual money moving around, and this reminds me of the discussion which is often heard that the quantitative easing programs that the Fed and other central banks around the world ran for many years did not involve actual printing of money. You could often hear people like Ben Bernanke say that. Literally, it would not involve printing of dollar bills and then transferring them, let's say, back to the example I gave a moment ago of paying, say, JP Morgan for lots of 10-year or 30-year treasuries. What would really happen is that the money would simply be, as I say, added to the reserve balance that, in that case, JP Morgan had within the reserve system. Now, let's have a look at the assets on the Fed's balance sheet. And you can see this was updated here on the 28th of August, 2025. not that far from when this is actually being recorded. This comes from the FRED database, which is part of the St. Louis branch of the Federal Reserve. And let's walk across this timeline here. It goes back to 2004. So here we can see that the assets on the Fed's balance sheet in 2003-4 were around $800 billion. And that remained fairly stable until we came here. Now this obviously, the shaded area represents the financial crisis and the associated recession with that. And this was when the Federal Reserve began its first QE program here in 2008. This is when it went to the banks and said, we're going to buy up a sizable amount, hundreds of billions of dollars actually, of securities, Treasury securities and MBS. So that increased the balance sheet here to over $2 trillion. There were a variety of QE programs. You can see another big one started here in 2013. Here we can see that the overall size of the Fed's holding in terms of these assets I described, Treasuries and MBS, had reached a level of about $4.5 trillion. Now that started to decline here. And it wasn't because the Fed was selling the treasuries that it had been accumulating starting back here, but it simply allowed the maturing treasuries. So if you bought, say, a 10-year, if the Fed bought a 10-year here, that would have been maturing and it would simply roll off the balance sheet. There was discussion about the Fed contracting or shrinking the size of its balance sheet, but it never actually got round to it. And then, of course, what happened here is the onset of the COVID pandemic. Now, it's remarkable to look at this now, but if we look here in early 2020, the balance sheet size was just around $4 trillion. That then moved up very decisively initially and then incrementally over the subsequent years, and actually by the time we got sometime into 2022, the size of the balance sheet reached $9 trillion, $9 trillion here. This is when there were issues to do with inflation. This was when the Fed decided to start hiking short-term rates, and they began to reduce the size basically by selling some securities that they had been buying throughout this period. Now you can see an interesting little change of course here. This was in 2023, and I won't say much more about it to say that it was simply the Fed's response to the collapse of Silicon Valley Bank and some concerns at the time that there might be potentially another banking crisis. Fortunately, that did not turn out to be the case. And then the Fed resumed the sale of these treasuries, and as and when this is being recorded in late August 2025, the balance sheet size is $6.6 trillion. So it has come down considerably from $9 trillion, but still, of course, way above where it was back here before the financial crisis. Just a quick explanation of the composition of the Fed's assets. This is not entirely up to date, but I assume on a pro rata basis it would not be dissimilar to where we are today. You can see that the back here, this was when the balance sheet was at its maximum of $9 trillion. $6 trillion of that was in the form of Treasury securities, so roughly 2/3. MBS was this amount here, and this would be various other assets that could, for example, even include gold bullion. With regard to the liabilities on the Fed's balance sheet, which of course must match the assets, so once again we're looking at this maximum level here of around $9 trillion. We can see currency, and I mentioned already this would be currency in circulation. Now this would be reserves. This would be essentially the deposits that the banks are holding within the Federal Reserve System, so they would be a liability from the perspective of the Fed. This would be reverse repos. Now this has to do with the repo activities that the Fed provides, and as I say, I have covered discussion of repos and reverse repos elsewhere on my YouTube channel, and there'll be a relatively small amount of what are called other liabilities here. Just while we are considering the massive expansion really in terms of the assets on the Fed's balance sheet, why don't we put this into the context of what was happening on a global basis? As can be seen on this chart, we can now look at the cumulative balance sheet sizes for these 5 central banks here. We have the ECB, the Fed, the BOJ, the Bank of England, and the Swiss National Bank. And you can see these are broken down here. So down at the bottom, this is the expansion of the ECB's balance sheet. And we can then see the Fed, when we just looked at that, and the BOJ, and so on. Now, it is remarkable that when we look here at really the maximum size of these different balance sheets, we moved all the way here from $2 trillion back in 99 to almost 28 trillion in 2023. That is almost a 15x multiple, and obviously that meant that the world's liquidity, money supply, however you want to describe it really, had gone through a massive expansion. And many people, including myself, would say that that might well be the best explanation for the kind of inflation that was seen starting in 22, 23. There are obviously many other factors to do with the pandemic and various other factors, but clearly this is an enormous increase in the size of the balance sheets or the assets being held by these 5 central banks. Now, I just want to touch on a couple of other issues before we conclude, and I want to talk about duration risk with regard to the Fed's balance sheet. Now, as discussed elsewhere again on my YouTube channel, in an environment where, let's say, the central banks, including the Fed obviously, were buying a lot of treasuries, trillions of dollars worth, and many of those treasuries that they were buying were long maturity, long duration, with relatively low coupons. If you think back to the kinds of bonds, 10-year bonds and 30-year bonds that the Fed was buying during the pandemic, the coupon, for example, on some of those bonds was 0.5% or 0.6%, and what have you. Now, in an environment where short-term rates and the whole yield curve is much, much higher than it was back in that, say, 2020-21 period, we can then see duration risk. The fact that the bonds that the Fed is holding on a mark-to-market basis, not necessarily that the Fed has to do that, but it is a factor. These bonds would obviously be substantially at a discount to their par value of, let's say, $100. Now, the unrealized losses on the Fed's balance sheet have arisen in recent years because of the much higher interest rates today, certainly than was seen back in the COVID period, 2020-21. As interest rates rise, the market value of long-term fixed income assets, especially treasuries, creates mark-to-market losses. As I said a moment ago, the Fed is not necessarily mandated to apply strict mark-to-market accounting, but it is obviously a factor that needs to be considered. The losses will remain unrealized if the Fed has not sold the affected treasuries before their maturity date. Now, the Fed has actually been selling a number of these long-term bonds with very low coupons and realizing actual losses. But as of the end of 2024, the Fed had an unrealized loss of more than $1 trillion. I might just point out in this context, the Bank of England, which is now engaged in quantitative tightening, has experienced realized losses, in other words, actual through the sale of the gilts into the market, which have been sold at a significant discount to their par value. The Bank of England's approximate losses in this regard are somewhere around 100 plus billion pounds. Now, the final point I want to touch on briefly is to do with what's sometimes called yield curve control. And this is where, say, a central bank like the Fed engages in somewhat unorthodox monetary policy with a view to achieving certain target rates for different maturities in terms of all the outstanding Treasury securities. And the Treasury Secretary Besant has said that he would very much like to bring down, on a relative basis, the yields on the 10-year and longer term part of the US Treasury yield curve. And one way that he is going to do this is by reducing the issuance of longer term treasuries, 10 years, 30 years, 20 years, and so on, and increase the issuance of shorter term securities, treasury bills, 3-5 year notes, and what have you. So let me just conclude then by saying that at the end of June 2024, the average weighted maturity of all marketable US Treasury securities was approximately 6 years, a bit less than 6 years, 71 months. And the 20-year historical average for this is roughly 5.33 years, 5 1/3 years, 64 months. That has its own challenges for the Federal Reserve, because we're now in a situation where the Treasury is required to refinance its debt on a more regular basis than, say, certain other central banks. For example, the UK has a significantly longer average maturity for its government gilts. According to the UK Debt Management Office, which is a division of HM Treasury, the average maturity of the gilt portfolio is approximately 14 years. Now, that has both pluses and minuses associated with it. On the one hand, it means that the Debt Management Office is not so focused on refinancing the gilt securities, but on the other hand, it does not have the flexibility that would enable it to be more opportunistic in terms of issuance, to take, say, example of issuing more debt when interest rates are relatively low. The average maturity of 14 years imposes a more rigid kind of structure in terms of the issuance of UK gilts. Well, I hope very much that you found that discussion to be of value and useful and interesting. And could I once again remind you to subscribe to my channel, the Corcoran Codex. It will allow you to receive notifications as to when I add new material, which I do on a regular basis. All of the material is around this general topic of analyzing critical ideas and episodes in the world of global finance. Might I also just take this opportunity to mention 2 books that I have written over the years, both published by Wiley, and you can see them there. Thank you very much for watching.